Ladies and gentlemen, good day and welcome to the Bata India's Q2 FY24 earnings conference call, hosted by Axis Capital Limited. As a reminder, all participant lines will be in a listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal the operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gaurav Jogani from Axis Capital.
Hello everyone. On behalf of Axis Capital, it is my pleasure to host Bata's Q2 FY24 earnings conference call. From the management today, we have with us Mr. Gunjan Shah, Managing Director and Chief Executive Officer, Mr. Anil Somani, Director Finance and Chief Financial Officer, and Mr. Nitin Bagadia, Company Secretary. Thank you and over to you, sir.
Thanks, Gaurav and Axis Capital. A warm welcome to all of you. We have Gunjan, who is our MD and CEO. We have Mr. Anil, who is Director Finance and CFO. We have shared the presentation with the stock exchanges a little while earlier. We would be taking you along the presentation on this call. We will navigate the slides as well as the page numbers to stay connected. On slide number 2, we have the disclaimer. I'm sure you have gone through the same. I hand over to Gunjan now, and thanks again for joining.
Hi everyone. I hope you all are getting my voice. So I will then start off on slide number 3, which is the layout of the entire short presentation that we have for you, and then we will open up for Q&A. Moving on to the next slide, on some big highlights before we get on to some operational highlights. Footprint extended to about 2150 in terms of points of sale. We did also in recent past conclude the strategic alliance with global brand 9 West to enhance the global style offerings to Indian consumers. Sneaker Studios continues to expand to now almost 600 plus stores. Floats has our casual washable footwear offering, which was started almost about 2 years back. Continues to keep ramping up every quarter, and we have now backed it with further manufacturing investments, etc. We feel very robustly on it, and that continues to grow well. And our technology investments are on track. HPM has already gone live, and the merchandising tool has gone live. And the other big piece, which is the ERP schedule, is on track and scheduled to go live as per plan in quarter 4 of this year. Moving forward, the strategy chart, as I have mentioned, basically driving portfolio evolution, and I'll talk about each of these in some detail going forward in the subsequent charts. Retail excellence, both expansion, renovation, as well as basically in terms of multi-brand outlets. The third is basically in terms of investments behind Bata brands to ensure that we bring in saliency on the brand as well as connect with the youth and drive style imagery. E-commerce and therefore digital footprint continues to expand and has been an outperformer in a relatively muted quarter that we had. Making sure that the supply chain becomes more and more agile and efficient. There were a couple of large projects that we have implemented. One was an exceptional item which is there under VRS as well as in one of our units, and also installation of a significant engineering capability on the IM EVA, which should amongst others basically also fuel the floats growth. Staying nimble on costs, overarching all across the entire value chain and trying to bring in variabilization to cost structures. Last but not the least, talent, process and technology. I mentioned a couple of projects on that front that have moved forward. Anyways, I will talk in the subsequent charts. So I will quickly move on to slide number 8, which is point of sale. So we continue to expand. It's a consistent trajectory, but however, a very prudent trajectory, and I think it will stand us in good stead. It's a good mix of COCO stores, which I had mentioned about 3-4 quarters back, that we have now added net COCO stores additions, but in a prudent manner. we will continue our significant expansion on the franchise store additions. There will be obviously additions that we do, which is the smaller ones, which is on SIS. What we have also opened up in the last quarter with some decent additions, and which should be resulting in much better trading density and sales per square foot, is the pop-up stores. We've opened almost now 10 pop-up stores under the Floats banner, one under Hush Puppies also, and these are basically ranging from about 100 square feet to about 250 square feet for Hush Puppies, and we are having strong ambitions going forward on that front. This addition will continue. However, as I said, COCO versus franchise will be in the ratio of about 80-20 at a ballpark level. Next chart on slide number 9 is on franchise specifically. I think I had stated that basically by FY25 we wanted about 500 stores. Till 3 years back we were less than about 150 or so. We've had consistent trajectory, as you can see, and that trajectory continues. Last quarter was relatively a little lesser than what I would have expected, but we will see again that ramp up. I think it's a temporary, number that came below 30. But otherwise, we've been adding in the range of about 30 plus every quarter, and we would like to continue that. That fueling continues. We are also now on that front, not only enhancing the bandwidth and therefore the pipeline from franchise additions, but also now moving towards making sure that existing partners open more and more stores. Right now, almost 40% of our new store openings come from existing partners. We want to ramp it up to almost 60%. And I think that's a good sign that basically partners that are people who understand Bata, people who understand the category are the ones, and therefore they mature, new stores mature much faster, and they are able to realize benefits much faster. On the multi-brand distribution business, while it has been a relatively muted on that front last quarter, the platform continues. As I had mentioned, we will now be, and as you can see, and I will talk about it a little more in subsequent quarters also, we will be now wanting to look at depth and extraction, and there are two large levers that we are working on that front. One is on specific categories where we feel that there is a right to win, as well as sizable potential for revenue. And within that, I think ladies value-added, plastic value-added, as well as sports is something that we have made some significant seeding. We have seen some very good response. I don't think it has been commensurately impacted on turnover yet, but we are hopeful that in the ongoing quarter as well as the subsequent, we will start seeing benefits. I think there is a very large benefit there. The second piece on extraction, which is not mentioned here in the chart, but we will track for benefits and therefore share with you, is on control on secondaries and therefore outlets. We are investing in technology, in key retail outlet programs, as well as feet on street, which gives us much better ability to control the way Bata is presented and showcased to consumers in multi-brand outlet environment, and therefore enables secondaries and therefore better extraction from the kind of distribution reach that we have now made progress on. So that will be a big pivot that we will see within the distribution business going forward. Moving on to slide number 11, digital. I think it's been a relatively outperformer, though I think the growth rates would have got a little muted. While it's been strong double-digit growth, would have got muted because of shift of season, and that's obviously a spillover that's gone into October, etc., as the partners also started taking in their inventories. But I'm sure it will all flow back into this quarter. It is also backed by a couple of other initiatives besides marketplaces. We have also ensured that we are now penetrated into additional accounts like Tata Click, Nykaa, etc. We have also seen some encouraging response. We have transitioned from Bata.in to Bata.com in the last quarter, and that has given us some significant benefits of scale that comes from search engine optimization, etc. And last but not the least, the omni-channel business, which is a significant addition in addition to the pie that you see here. We do now almost 4 to 5% of our retail turnover coming from omni-channel, and that has now been, it was hitherto being done in the COCO business. Now it has been also, the model has been fine-tuned for the franchise, And out of the about close to 500 franchise stores, 300 have been enabled through the home delivery channel. Moving on to slide number 12. What we see here is the campaign that we have driven during this quarter. Some of them were towards the lag end. So I think I'll take them in the reverse sequence. Basically, Power Apparel is what we launched as a pilot. I talked about it. Power Apparel it continues to give encouraging response in the pilot stores of 60 stores that we had launched it in, 62 stores. It is now contributing to almost about 2 to 3% in that range across these stores in terms of same-store growth. Our ambition is to make sure that as we get the learning right on two fronts, there are several learnings that we have seen. One is on the merchandise front in terms of colors, styles, what works, what doesn't work, the mix between bottoms and tops, ladies and gents, etc. And that is something that is being fixed as we replenish the merchandise, etc. The second piece that's there is also how is it positioned within stores. There are several learnings within that. Wherever we have positioned it slightly back end of the store or at the next level, etc., we've not seen the similar impact. Therefore, those corrective actions have been taken. In some cases, we have also modified the stores. Our objective on apparel is to make sure that while the size of the category is large, we get our complete understanding right before we really scale it up and leverage across our network. And the thumb rule for that, which I have set for the team, is that we need to see 4 to 5% same-store growth from apparel contribution to the store sales, which gives us a good understanding that we are consistently able to scale this up going forward. So we are well on track on that, and we'll update you regularly. We did run, obviously, the entire campaign, which is now into 3 parts, which was Pujo, Red Label, Casual Style campaign, all under the ambit of every walk is a ramp walk. The strategic direction that we wanted to drive through this campaign, it is a very large campaign. It's ongoing as we speak also. It has been towards driving the style quotient led by Bata Red Label and obviously the entire portfolio of brands and products that we offer. It has had a very good response, and you will see that in the highlights when I talk about certain categories on the style quotient, etc. Moving therefore on to basically the next chart, which we will is on key categories that have done relatively well in this otherwise muted environment. Has been North Star, continues to grow in double digits. Comfort continues to grow in double digits. Hush Puppies saw some moderation on a maybe elevated base on the premium front last year, but continues to still be accretive in terms of growth. And floats I've already talked about. There is not only growth over last year, which are very attractive, but also sequentially. It also comes at a significant delta margin, which will further get enhanced as we get the in-house manufacturing for floats going. Therefore, then, moving on to slide number 14, is some key business highlights. Is basically gross margins saw some prudent management during this quarter. Combination of basically managing obviously the channel mix in a way, but more importantly discounts as well as inventory management. And I think that showed up. Our inventories are actually in a place where we feel very comfortable, and I think it's in the right mix. And hopefully, I think the merchandising tool that we have automated all across, which is getting rolled out in this quarter, will give us further benefits on much more agility on inventory management. So I think that's one thing that would be a highlight that I thought I'll share with you. Red Label, the style first brand from the Bata banner, I think has been exponentially growing. Albeit on a low base, but now the bases are no longer small. It contributes, just the Red Label brand itself contributes to almost now 4% of our turnover. And we are looking at that continuing to grow and fuel the entire style imagery, in addition to obviously associations that we have with brands like Hush Puppies and now even Nine West going forward. I talked about this, which is the I Am Eva capability machine. It is about investment that we have done, and we have installed it in Batanagar, and should significantly enhance not only our understanding of this entire product, but bring in significant agility in terms of bringing in innovations as well as freshness into this entire category. It's been successfully commercialized, and we will see commercial production coming out of it in the next few weeks. So it will fuel this entire thing of floats, which is basically now inching towards almost 16,000 pairs per week kind of weekly sale. And we are now wanting to push that even further. With, as I mentioned, we have also opened up the entire concept of floats as an independent brand outside the Bata banner with the floats pop-up stores. We are now in almost a dozen locations, actually 12 as we speak. And ambitions are to take it as fast as possible to about half a century. As we expand our range, bring in much more innovation, etc., and fuel some of it because of the investment in the back end, we will see this entire thing spawn off even larger as the response goes. In addition to that, we also had a power apparel that got stabilized, which I've talked about. We also had significant success in the power step and go category. While we ran out of stocks on that front, but there is active work happening. In the next few weeks, we should have stocks getting replenished on it. We had a very exciting response. It was at ASPs which are 2x of the power ASP itself, and which itself is 2x of the Bata ASP. So we feel very excited about that category going forward. And Omni business I've talked about, I think it continues to ramp up. It continues to help us manage. In fact, that has got a very strong correlation not only to consumer satisfaction on one side, but inventory management on the other side. And it gives us confidence to tightly manage inventories because we can drive this entire home delivery channel even better going forward. On consumer facing, we are in the process of rolling out brand stories across a very large scale. We've done pilots to some exciting response, primarily anchored around comfort, around Shoal, as well as around power. And we will want to see, and red label, right? So we will see this now scaling up. This quarter should see about close to 400 stores getting impacted by these, where you have the story that along with a collection coming together and talking to consumers. We will see next year that going into almost about half the network, which is about 600 to 700 stores. Customer complaints and therefore quality remains under control and a good trajectory. And the store experience score that we keep tracking is at elevated levels. At an overall level between Bata and Hush Puppies obviously at the premium side is even higher in the plus 80s band. On other highlights, BIS, which is in the offing, I think the notifications are out. There are further clarities that are emerging. I think the government has been reasonably helpful on this entire front in making sure that people who have strong domestic manufacturing capabilities, they are enabled, and we are well on track. Several of our source base and manufacturing sites have got certified, and we are well on track to have a very smooth transition into BIS. 3PL implementation, part of the entire variabilization of costs, is now stabilized in the North Depot, and shortly we will be going live in it in one of our largest southern depots. So that's something that should give us continuing leverage going forward. VRS I've spoken about. We have launched VRS about 4 months back. We had in one of our South units, and that is something that is tracking well as per the plan, and which should give us significant leverage on our agility as well as upgraded capabilities, which were hitherto not available in that existing factory of ours. The variable incentive structure continues to progress. On the retail store front, we have now launched a temporary program in last quarter as well as this quarter, which takes up this entire piece to our desired level of at least 30%, and which, based on response that we see and some modifications, we would like that 30% variabilization of store remuneration to structurally get impacted from next year onwards as a continuation. Last but not the least, corporate social responsibility is not only in regulatory compliance, but also a purpose that we carry across from Bata as a philosophy, and one of the cornerstones of that is employee volunteering. And we achieved a significant milestone on the Bata Founders Day, which involved all our employees contributing 1,000 plus hours on that day itself. Moving to slide number 6, the financial highlights. As you can see, revenues were muted at about -1%. I think EBITDA came in relatively stronger at about 12.8% growth. This was, as I said, a combination of two, three things. One is prudent management in terms of gross margins. I think we did make sure that we were extremely diligent in terms of both in terms of the kind of mix that we were selling, premiumization that we were driving for, as well as markdowns and discount and promotions. And that finally got leveraged into basically profit before tax. In addition to that, there were significant initiatives across the organization on cost efficiencies. Some of them I've talked about in my previous chart. We did have an exceptional item that gave us a hit of about 41 crores related to the VRS that I talked about in South Can, resulting in a depressed PAT at about 34 crores for the quarter. That brings me to the end of my small presentation to you all. Thank you so much. More than happy to take questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Our first question comes from Nihal Mahesh Jham with Nuvama. Please proceed.
Yes, thank you so much. Am I audible?
Yes.
Yes. Good evening, Gunjan. 3 questions from my side, if I could take it. On the growth part of it, you did allude to that there was a shift in the festive period. Would it be possible to get more sense on that from the perspective of what was the SSG for the quarter ballpark, and what, in your opinion, was the impact in the shift in the festive on your performance?
Can you just...
How you said SSG what and...
Can you just repeat that question, please?
I'm so sorry. I was saying that I was looking for what was the ballpark SSG for this quarter, given that we've done quite a aggressive store addition versus last year. And also, excluding the impact of the shift in the festive, what would our growth have looked like, or SSG, either way you want to comment on it?
Yeah. No, so I think basically the piece that is there is on store additions. I have mentioned this, that because a large number of them come from a franchise, so cannot be numerically added in terms of weightage. But however, on SSG, we were at basically in low single digits negative for the quarter.
And what would have been, if say the festive would have not shifted, what in your opinion would have been the growth like, if you could just give a sense of that?
Should have been positive in our estimation, right? And but however, we will have to wait and see how the entire follow-through happens. There is some early signs of impact of the festive season coming through, as well as obviously, the campaign and initiatives, etc. But we'll have to wait and watch on that.
Thanks, Gunjan. Gunjan, the second question was on the 9 West tie-up that you announced a few days back. If you could just give a color in terms of, I think 9 West doesn't have its own EBO network. So is it going to be rolled out across our 1,700 stores? And what is the kind of revenue potential we are looking at, including margins, assuming we're doing the manufacturing for that also?
Okay. I've understood it. While I think the voice got a little muffled, but basically what you're saying is that what does this entire piece on 9 West entail? So 9 West is roughly, about $1 billion plus retail sales brand globally, with obviously significant part of it coming from the Americas. It stands for fashion as well as youth and a combination of that, and therefore bringing in on-trend styles, and that's the leverage that we are looking for at the premium end and at the youthful end. It is a manufacturing as well as a licensing arrangement. It's the full license arrangement, exclusive for the markets of India, and therefore will be applicable across our business channels. So whether it's the COCO, whether it is our franchise, whether it is e-commerce, or whether it is the multi-brand outlets also, potentially. Right. Now, we will fructify this entire piece in terms of actual rollouts, etc., over a period of time. But basically, the point is that we will want to expand this across the network as applicable, and it will by far, the first and foremost will be making sure that it starts rolling out in our top stores, etc. But over a period of time, we will see what's the appropriate level of penetration, as well as eventually even bringing in EBOs, etc., which is also part of the licensing arrangement.
Do we have online rights also for this?
Yes.
Just one last question from my side, and Anil, this would be maybe preferred to you, that if I look at our annual report, I do notice that our rental expenses have increased significantly versus last year. So, and I don't think we've added that many EBOs, both from the reported and a cash basis. So, any specific aspect there to be aware about?
Mahesh, right? Nihal, if you can just, be a little slow on your question. There is some muffling noise coming so that we can understand the question.
So your question was in the last annual report. Can you repeat, Nihal, please?
So sorry, I was asking that when I was looking at a rent cost for this year, both on a cash and a reported basis, I see quite a significant increase on a per square feet basis. Just wanted to check what is the reason for that, if you could highlight the same.
This is, you're assuming when you say annual report, you're talking about FY23 versus FY22. Is that right?
Absolutely, yes.
Okay, so there are obviously one reason, and I will, will be able to provide more detail. But in that year, there was it's a sort of a non-comparable period. In the previous period, many of the retailers, including us, got the benefit of, the COVID impact. And as a result of it, the numbers are not comparable.
Sure, maybe I'll connect offline to get more details on it. That
Sure.
will be it from my side. Thank you so much.
Thank you.
Our next question comes from Girish Pai with Nirmal Bang Equities.
Yeah, thanks a lot for the opportunity. Gunjan, we have been speaking about Bata India becoming a sourcing point for Bata Global for its footwear needs. Where are we in that journey? Can you just give some update on that?
Yeah. So the journey continues, Girish. We are actually now we have most probably done this year a significant start to it by exporting to almost something like about half a dozen countries of the Bata footprint. The piece is progressing as per plan. It is also basically being it is also now working on basically also ensuring that whatever was getting connected, there were separate teams that were also sourcing for Bata. That is also getting merged and therefore getting supervised in. And I would say that I think this is working pretty aggressively, and we will keep updating you on that front on how we progress on that. We should be looking at most probably this year under our supervision. We should be looking at about 1 lakh pairs going out of from India. And even more ramping up next year.
Okay, my second question is on Nine West. From a brand perspective, do you think it could become as big as HP Hush Puppies, say, over the next 5 to 10 years?
That's exactly the kind of ambition that we have. We do see potential in it. We do see, exclusive, understanding on styles and therefore style quotient coming through. And obviously some amount of heritage, as I mentioned, of the global parentage coming through on that front. And that's the whole objective of what Hush Puppies has done largely on the men's side, while Hush Puppies now has almost 30% ladies contribution. But on the fashion side, etc., that's what we are expecting Nine West to deliver to us.
And what has been the recovery on the mass segment side, sub 1,000 price point or sub 500 price point? Those were like weak areas of our business. Has that recovered?
I would say that there is still a mixed bag on that front. We have still not seen a secular recovery on that front. I think also we have also consciously tightened up our purse strings, both in terms of outstandings, so credit periods, as well as in terms of discounts. And I think that might have delayed it a little. But my sense is we are hopeful that I think it will sooner rather than later actually start converging now in terms of premium versus mass. So that should, as I have been mentioning several quarters now, that these are cycles, and we are hopeful that the cycle is showing signs of balancing out.
Yeah, my last question is on the cocoa part of the business, which is still a fairly substantial part. What do you think should be the growth rate one should be penciling in, and how much of that would be ASP driven, in your opinion, over the next 3-4 years?
So on the cocoa part, we see basically the point is that we would like to see high single-digit sales store growth, right? And half of it should be coming from premiumization, I would say, not price increase. Price increase we have largely staved off from for almost now 4 to 5 quarters, and half of it coming from pairage growth.
Okay, thanks a lot.
Our next question comes from Varun Singh with ICICI Securities.
Yeah, thanks for the opportunity. So my first question is on the premiumization bit. So where do we currently stand in our overall sneakerization and premiumization journey? Because ever since we started setting up sneaker studios in our stores, it has been more than 7-8 quarters. At the same time, our pace of adding sneaker studios in stores, that has also fallen down significantly since last 2 quarters. I mean, hardly 30 or 35 to 45 stores is what we are adding up. So can you please give some understanding over there?
Yeah. So, basically the entire piece, there were multiple legs to this entire sneakerization story. So if I dial back a little, almost about 18 to 20 months back is when we started this entire sneaker studio concept, which was bringing across the entire offering of sneakers under the Bata banner together and make sure that it impacts the consumers. That was the first leg that fired off. The next piece, I think very closely, but I think came with a slight lag of about, let's say, a quarter or two, was basically entire merchandise and bringing in basically fresher styles, etc. Largely driven through North Star, and which is what basically is what I highlighted is driving it. I think the piece that we are now wanting to basically drive this even further is going to be making sure that power comes alive. And therefore, as I talked about, I think bringing in not only the power products through, I think some of the work that we have been talking about in terms of technology, etc., and bringing in unique propositions, which is that we want power to stand as, democratizing fitness and technology, is something that you will see fructifying over the next few months. And that's where the next leg that we see on this front. What will also happen along with this is that we will want to make sure that power also is going to be the anchor of our proposition to consumers from a brand perspective. And we will see significant investments coming through on that front also. So we had sneaker studios, we had unlimited sneakers as a campaign, which was bringing alive to consumers and registering it. That gave us a big shift in terms of almost 400 to 500 basis points in terms of contribution of sneakers. Making sure that we bring in lifestyle and therefore much better styles and colors under North Star. And I think the next journey or leg of the journey will be power. So that's how I see this journey on sneakerization. It will continue. I don't see any reason why we should not be participating, because this is the fastest growing, and I think there is still a lot of backlog that we need to clear on this front.
Understood, sir. Sir, actually my question was that in how many more stores we want to implement this program, or are we largely done with regards to how many stores we would have aspired?
No, I got that. I missed answering on that front. So the initial piece when we did the sneaker studios was basically driving this across obviously our stores. What we are now doing is that we are now doing it along with the entire renovation so that it becomes more efficiently. So yes, you are right in terms of seeing that the pace of the sneaker studios is going to now come at a slightly lower level. But I think the Pareto contribution stores, etc., have been activated. So now the next lever is basically in terms of merchandise as well as brand proposition, etc., to consumers, which is what I commented on. But you're right in your observation.
Got it, sir. Very clear. And sir, a follow-up on this is what would be our revenue contribution from sneakers as on today and compared to maybe like a year back?
So From 2 years back, we would be about 500 basis points higher. From a year back, it would be slightly muted, and that is largely because I think, the piece that was there in terms of power is still to be completely clicked. I think in September onwards, once the step and go, etc., so the merchandise started filtering in, we have started seeing that coming back. So, about 500 basis points over 2 years.
Understood, sir. And sir, my last question is, like on the premiumization slide, we see a strong growth in almost all the brands, excluding Hush Puppies, compared to last quarter, 5% growth. So, what explains this relative underperformance in this brand?
I think it's also that Hush Puppies saw extremely high growth last year, Varun. Basically, it saw extremely high growth. I think there was some amount of COVID and maybe post-COVID bounce. That I think might have resulted in some mutedness, but our ambitions on Hush Puppies, in fact, I think this year we are likely to exit December with about 120 plus stores of Hush Puppies, and next year is going to be even stronger additions. So a large part of this addition that we are talking will start also now. Hush Puppies will have a significant contribution. The other big piece that we are also going to invest in Hush Puppies is renovation of stores. A large part of the renovation that we have done have been in Bata stores. Hush Puppies has not been invested in as much from a store experience point of view, and that will undergo a big change. The first new concept has been opened in, I think in southern India and Kerala, and there will be a whole bunch of work that's lined up for the next 2 quarters. So Hush Puppies will continue. This quarter might be an aberration.
Thank you. We now are going to have a question with Mr. Gaurav Jildani. Please proceed.
Hi, Gaurav.
Mr. Gaurav, your microphone is open.
Hello. Sir, am I audible? Hello?
Yes, Gaurav. Now you are.
Yeah, sorry. So my question, is with regards to if we see that, while the premium part of the portfolio is seeing good growth rates, both floats, Hush Puppies, even if I consider the base, and the North Star piece as well, which means, that the value end of the segment, is it declining in high double digits or maybe mid-teens kind of a number? Would that understanding be right?
And especially when you look at the one that is below 500, yes, you are right. But as I mentioned to someone else just a few minutes back, we are slowly seeing that now narrowing down. The gap that we had, let's say about 3-4 quarters back of premium significantly outstripping the mass, I think that the trains are now slowly converging. And that I have mentioned it, that these go through cycles, and we are hopeful that they will, the mass market should also start bouncing back. I think consumers have seen a lot of inflation. We have taken up prices, let's say 2 years back or so, 1.5 years back. We have very consciously stayed away from at a very broad level of any price increases for almost now 4-5 quarters. And we see raw materials stabilizing, and therefore I foresee that consumers will get a little more comfortable in terms of the discretionary spends coming over, provided the overall macros work well.
Sure. So, sir, my follow-up question to this is, given the fact that in the morning on the TV interaction also you mentioned that you will be targeting double-digit growth rates. And if I have to bifurcate the growth rates between, the premium portfolio and the mass end of the portfolio, how would you be looking at be the mass portfolio now given a low base to grow a bit higher, and the premium portfolio maybe take a little backseat, or both will continue to grow at the same pace?
No, both will continue to grow. I would say, there might be a quarter or so where there might be some rebalancing, but at if slightly more medium term, which is where my commentary was, I would say that our premiumization journey will continue, and therefore I don't see why premiumization, a premium part of our portfolio should be at least 1.5x of our overall growth.
Sure. And so the second and the last question, is with regards to the growth rates again. I understand, that the addition largely has been on the franchisee part of the business, which is again a lower contributing in terms of the reported numbers. So if you can bifurcate for us, what kind of growth rate drag you see from the franchisee piece of the business in the overall numbers.
Okay. So, I think we track growth rates of franchises at multiple levels. So now the network is large. However, as you rightly said, and as I mentioned it, the reported turnover that comes through at a discounted level, right? And these are smaller consumer cohorts, which hitherto we could not access to through a COCO format. So all of this I've spoken about. Notwithstanding that, it's now becoming reasonably sizable. It is now close to double digit in terms of contribution to our sales. And we are looking for basically this continuing to expand significantly going forward. It is, inorganic and organic combined. It is growing in very high double digits for the last several quarters now. It's also, as I mentioned, significantly accretive from a capital as well as fixed cost perspective, and therefore from a EBITDA level.
Sure. So just one clarification. When you say double digits, you mean the SSG growth rates or the overall growth rates?
Both. Last quarter, though, the SSG would have been still positive, better, but it would have been a little more muted considering the overall discretionary demand. But let's say over 4 quarters, it has been in double digits on SSG also.
Sure. Thank you, and that's all from me, sir.
Thank you.
Thank you. Our next question comes from Abhishek Gedan with Invesco. Please proceed.
Thank you for the opportunity, sir. So my question is, I wanted to understand our strategy and initiatives on tier 2 and beyond. So I do understand our renovations and sneaker studio launches and premiumization story for tier 1. But how are we looking to grow in tier 2 and beyond?
Okay. Can you just, Abhishek, repeat that question? It was a little muffled.
Yeah. Is it audible now? Better now?
Yes.
Yeah. I said it's very heartening to see our sneakerization and premiumization story. But I was asking, how do we look to grow in tier 2? What are our initiatives and strategies for that?
Okay. So multiple legs, Abhishek, on that front. So first and foremost is what I was just talking to the previous caller, which was on the franchise expansion, a large part of the franchise expansion. So let's say, for example, over the last 4 quarters, we would have added almost about 120 odd stores in franchise alone. I think of almost 90% of those have come in tier 3 and below towns, right? And that's where in many of these towns, we are the first branded store of footwear that's opening up, etc. And that does give us inorganic first mover advantage on that front. The ASP at a retail price level of these stores also is not very different from our COCO ASPs, but at about 20% lower than our Metro ASP. So it's not so low. At a margin level, in terms of profile of products, etc., it is reasonably at par, leaving aside obviously the fixed cost and the capital cost leverage that I get on the franchise model. So that's on one side, which is expansion, sustainable, profitable side. The second piece is basically that we want to also make sure, while we have now devised mechanisms of trying to track, and there's been a lot of effort, especially post-COVID, of driving newness and freshness into our stores on regular season and within season drops. We are now wanting to percolate it down the top strata, down to the last, even the COCO store, as well as which go down the tier. Therefore, making sure that every season at least 20% of the portfolio across each category minimum is refreshed, and therefore consumers see freshness. The last piece that is there in this is this entire Omni piece, which opens up the entire portfolio of Bata without me having to necessarily invest in inventory all across all styles and all sizes. And which, as I mentioned in my presentation, that we are not only now successfully penetrated across the entire COCO network to a significant level, but also now opened up the entire franchise network to it, which allows the franchisee to also access the entire portfolio of ours without having to necessarily take the risk on some slow-moving or high-premium articles. So premiumization will also be driven down top strata, leveraged by obviously, as I said, freshness, etc.
That's very heartening to hear. So just wanted to understand that, just to get the number right, in tier 2 and beyond, or tier 3 and beyond, our ASPs would be roughly, or most of the products would be open footwear, or how would that mix be?
I don't have it handy in terms of, did I hear you right, open footwear?
Yeah. I mean, I was thinking more towards open footwear sales in those areas, in tier 2, 3 beyond.
I don't have it handy. My gut feel would be, yes, it might be a few percentage points higher, but not significantly. Yes, to the premium top-end 100 stores, my open footwear would be significantly lower, right? But overall, let's say the metro and tier 1 towns and let's say tier 3 and below, the ratio will not be significantly different. But ASPs would be, obviously, the merchandise mix, etc., would be a little more different, and that's what I mentioned. That's about thumb rule 20% ASP lower.
Right. So, and assuming that ASPs in this towns or cities would be around 500-600 for us, is it? I mean, you did say that it is almost at same profitable levels for COCO and franchisee both, but could you give some light on the numbers on margin side?
Okay. So one is, let me correct it. Our overall ASP of the retail network is in the range of about 1,000 rupees now, right? So it's been a premiumization journey that continues. Within that, I think that tier 3 and below would be in the range of about a thumb rule about 800. So it's not the 500 or 600 that you mentioned. The margin profile is similar. Maybe it's about 20 basis points lower. So it's to do with, the product profile is different, right? So I'm saying the amount of value addition that I do in the product, and therefore the price that I charge from the consumer, is the equation both changes, and therefore the margin is still reasonably stable.
Understood. Thank you for the detailed answer. So last question. So to grow more on the touch points side in the all over India, so do you think opening and franchising would be the way ahead, or going via MBOs or partnering more with distributors is the way ahead? I'm going on a larger base.
Yeah. No, so see, I think there is opportunities both ways, or actually 3 ways, right? 2 you have mentioned, which is franchise and MBOs. There is this entire piece of online, that is a third channel, and that's very important. And I think overall is also a very large focus, and I think that will, especially in some of these muted times, will help us, is focus on same-store growth. So all 3 or 4 of them will be worked upon and are part of the priority that I just mentioned when I showed the thrust levers in my presentation.
Right. So just additional question to that is, just like for next 1 or 2 years, growing on individual store basis, I mean growing on Bata store, it will still be a profitable business for our franchises, right? In tier 3 and beyond.
Yes.
Even our growth grows given our presence. Okay. Thank you.
Thank you.
Our next question comes from Ankit Babel with Subgan Ventures.
Good evening, sir. So my first question is just a clarification. You did mention in your TV interview today that you are targeting a double-digit growth. So are you targeting this growth even in this year, FY24?
No, so my comment was on what's the medium-term vision that we carry, and that is obviously that we want to make sure that we have double-digit growth. Profitable growth is what I mentioned, right? So we will stay with it. That's the vision and the levers and the plans that we carry. As I mentioned, like last 2 quarters, we've seen obviously some up and downs, so those will correct for themselves, but we will stay with that vision.
Okay, and second is the 5,000 crore revenue target for 2025. Just a clarification, this is a calendar year target or, like FY26 target?
I think this is some quick calculation that journalist does at times, Ankit, but we will stay with our vision of double-digit growth. That will eventually translate to 5,000 at the right time.
Okay. And last question is, sir, once you achieve this double-digit revenue growth in the medium term, can our margins be back to the pre-COVID levels? If I remember,
forward-looking forecast. The reason that I mentioned also on this commentary that I made on the revenue growth perspective is to just say that these are all the various levers that we'll work on, which should show us basically impact in that form. We always, as I mentioned, we would like to have sustainable, profitable growth. So our desire is to make sure that we maintain margins as well as be prudent about it, even more so in these tough times that we have seen recently. All the more reason, as I mentioned in my presentation at the start, that we would like to be very conscious of various cost lines, both fixed as well as variable.
Okay. Thank you so much, sir.
Thank you, Ankit.
Thank you. Our next question comes from Sanjeev Bandia. Mr. Sanjeev Bandia, you may proceed. Your microphone is open. We apologize. We didn't receive his audio. If you have a question, as there are no further questions, I would now like to hand the conference over to the management for its closing comments.
So thank you everyone for joining us. Looking forward to interacting with you again. Thanks a lot everyone. Thanks, Gaurav.
Thank you. On behalf of Axis Capital Limited, that does conclude this conference. Thank you for joining us, and you may now disconnect your line.